Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we going to talk about? Well, I think it's important for me to talk about surviving and prospering during a bear market. This is something that obviously I talk about whenever the market gets iffy, and I thought it'd be a quick little presentation. And I found myself about 2 days into this thing realizing that each one of these topics can be fodder for complete presentations in and of themselves. So I will do some follow-up on these either next week here and especially in this week's Dave Landry's The Week in Charts, which you can register for at davelandry.com/webinar. By the way, housekeeping, I do take requests. Lately, we've been kind of slammed with all this market stuff that's going on, but I do pay attention to what you guys are looking for, what questions you may have, and I'm happy to cover that. In fact, it makes my job a lot easier. Know I'm going to cover ahead of time. If you need more information, davelandry.com/StockCharts. You'll get the slides from this presentation, all the other presentations, a free market timing course, which I'll touch upon in a few minutes, all three of my books in PDF format, and a bunch of other stuff. You need to reach me, davelandry.com/contact. And again, if you want to join me on Thursdays at 6 Central, 7 Eastern, davelandry.com/webinar. As I say each week, register even if the link is old. So let's talk about surviving and prospering during a bear market. Now, this was left over from some slides I did in 2020. And it's just kind of interesting how trading, like life, it can go south really fast. If you'd have told me a month ago that I'd be stuck at home binge watching a series about a gun-toting redneck on meth with a dyed blonde mullet who's a polygamous homosexual, not that there's anything wrong with that, who runs a zoo with over 200 tigers and is fighting with a murdering crazy biatch, his opinion, who has quite a few tigers herself. Anyway, that was just a couple years ago we were going through that. So it does happen, and it does go south quickly. The number one thing you need to do is don't panic. Now, tops feel like an event, but more often than not, they are not. Unless, of course, you wait for the bomb to blow up. And I've been preaching about that since last summer. And that's why I did a presentation called Before the Bomb Blows Up. Because everyone calls me when the market is down 30% asking me what to do. In fact, a few days ago, I told a couple of my buddies, we were working out, I'm like, I got a sell signal. And they just kind of like, oh, okay, whatever. And I guarantee you, a month from now, or 2 months from now, or 3 months from now, if this market's down 30-40%, then they're going to want to know what to do. Now, the interesting thing is, again, markets tops just seem like an event, but they do take some time. And Greg Morris has talked about this before, but a top is actually more of a process than an event. And a bottom, believe it or not, is kind of an event versus a process. Not all the time, but just in general. If we look at the high back in 2008 on the S&P 500, notice that it took a while, several weeks, to get down to the 10% line, meaning that on a closing basis, it took 33 trading days to close 10% below that close. And what's interesting, that high close, what's interesting is it did bounce from there, and then it was 2.5 months total before it dropped back below 10% again. And I'm going to talk a lot about how important that 10% level is in a few minutes. So let's take a look at the S&P 500 recently. And you can see that it took about 2 months to get down to the 10% line. In fact, it just closed there last week. And if we fast forward to 2020, when we had the pandemic bear market, now that one unfolded a little bit quicker, but you can see it did take over a week to get below 10%, and then it bounced back up, and then it was about 2 weeks total before it was back below 10% once again. Actually, this needs to be a little bit higher. It needs to be right here. But the one thing that's kind of interesting is the market did lose steam for a long, long time. You could see it sort of topped out in here. This high was just kind of a marginal high. not much higher than it was back several months earlier. So there was a little bit of rollover that was happening. And as I said ad nauseum, what really impressed me about this longer term sell signal is that it triggered before a lot of the shorter term signals, such as the daily bow ties. Now, you might be wondering about the crash of 1987. Well, this was pretty interesting because the market made all-time highs here, and it took a while, about 2.5 months, before it dropped below the 10% line. In other words, for 2.5 months, it was within 90% of its all-time highs, and then you could see things went south really quick once it got past that 10% level, which again we'll talk about quite a bit. Now, if you go all the way back to the Great Depression, you can see the market made new highs, and I guess that was September of 1929, and it kind of meandered for a while, and then finally, about a month or so later, it did close 10% below that level. And let's say that you didn't get shaken out then. It's like, okay, well, I'm going to wait for another signal. And then you have a second signal here. You can see about 2 months total from that peak. So even though the Great Depression was a crash, so to speak, it actually took a long time before the market rolled over. 2 months, in fact. Number 2, I will see each position to its fruition. And this is something I talked about a couple of weeks back, and I also talked about it in the weekend charts a couple of weeks back too. The dotted line in this chart is the S&P 500. The blue line is ARLP. That's the stock that we were long coming into this slide. And the orange line is APG. Now, you can see obviously the market tanked seriously since then. And also the stock, APG, failed miserably. Now, the good news is we were profitable overall. I think we're up about 70% on that position, but we were up, I believe, triple digits, if memory serves, before that market began to roll over. And by the way, if you want to see all these trades without any benefit of hindsight, you can go to daylandry.com/archives, and you can see them each day that I recommended them. Now, what's kind of interesting is the ARLP started making new highs after the market was already down substantially, and it's since given up some of those gains, but in more recent times, it's starting to rally again, so it's not dead yet. I'm not dead yet. I think I'll go for a walk. The point I'm trying to get to here is not every time, but over time, if you just follow your original plan and honor your stops, because you never know what stock's going to actually take off, and the outlier is key when you are trend following. And just as important, if you bail on all your positions every time the market gets a little iffy, you're going to end up being out and then watch the market and your individual stocks take off without you. Number 3, be leery of asset gatherers with their sage advice. A friend of mine a few years back, he's an ex-broker, and he's actually a client who I became friendly with. But anyway, he told me back in his brokerage days, he realized at some point he was nothing more than an asset gatherer, and he wanted to become something more than that. He wanted to learn how to trade. But the asset gatherers in general tend to drink the same Kool-Aid, and they all tend to have this sage advice. They'll tell you, oh, you can't lose your position. The market always goes up longer term. Well, yeah, that's true. It really is. But as I learned from Greg Morris and a lot of empirical research, long before I knew who Greg Morris was, the longer term could be a long, long, long time. In fact, according to Greg, the longer term buy and hold metrics are based on an 81-year time horizon. And quoting Sweet Brown, ain't nobody got time for that. Now, this is what I heard recently, and I kind of like it a little bit, so I was hesitant to put it in here. Michael Saylor said this, and he's a huge Bitcoin bull. And I think I'm a Bitcoin bull longer term, but I do find myself short Bitcoin every now and then. And I think eventually I might hodl a little bit. But volatility is a cost of performance. And I think they kind of spin that to make you think that, hey, it's okay to lose 30 or 40 or 50% of your money every now and then, because longer term the market's going to go up, right? And unfortunately, the market is a really bad teacher. And I can think of many examples before the pandemic where people told me, man, I'm so glad I held on. And that's one of those things that'll work until it don't. Now, if you go back to the S&P 500 and you go all the way back to the 30s, you can see obviously the Great Depression peak is there. It took about 25 or 26 years for the market to make back all of its losses. Now, a lot of times people think, well, that was then, this is now. But look no further than 2009. And by the way, you'll get a copy of the Layman's Guide to Trading Stocks. And there's a lot of this type of information that warns the perils of buy and hold in the first chapter. I think it's called 10 Myths About Wall Street, or You've Been Lied To, or something like that. But anyway, I'd encourage you to read that book, and it's absolutely free if you go to davelandry.com/StockCharts. Anyway, going way back in time, the market hit 13-year lows, and I think the significance of this is, let's say you had a little toddler and you didn't have a whole lot of money for the first 3 or 4 years because, like, dang, these kids are pretty expensive. And at some point, you're about 3 or 4 years old, you're like, man, I better start saving for this kid's future. Better save for his college, right? And then all of a sudden, it's about time for him to go to college, and this market is hitting 13 years lows. It's lower than when you started saving. So that's kind of a scary thing when it comes to markets. Now, don't get me wrong. When the market is going up, I'm the bullish guy, the most bullish guy in bullish town. And I've got some relatives, specifically one in-law I'm thinking about. She only asks me about the market when the market is really crappy, and I tell her what I think. And she gets mad at me and says, you're always a bear. And I'm like, well, ask me about the market when it's going up. Now, one thing I would encourage you not to do is don't try to catch falling knives. I've been in presentations before where one in particular where they were speaking a different language, and I wasn't sure exactly what they were saying, but the gist of it, from what I could tell, was this gentleman was suggesting selling puts once a market was down so far. And I can assure you that'll work until it don't. So don't bottom fish. Don't try to catch a falling knife. If something seems low, it could go a hell of a lot lower. And if you think about it from an emotional standpoint, if a market has been dropping, it's putting pressure on people to possibly sell stock because people have bills to pay and things they might need. They might need to sell some stock to pay for junior's college. And if the market keeps dropping, sooner or later they could be forced out. Now, you only have to go back to the NASDAQ in 2002 to see that it had lost half of its value. And at that point in time, you're probably thinking, hey, that's pretty cheap. It's 50% off, right? It's on sale. I should rush in and buy the NASDAQ. Well, if you would have done that just a few months later, you would have lost over half of your money. It went down another 50% from there. Charlie Vallejo and Michael Gayard once did a presentation or a paper, I forget which it was, but they basically said that bad things happen below the 200-day moving average. And my corollary to that is bad things happen below the 10% line. Now, if you think about what these gentlemen are saying, is that once a market is weak, it has the potential to get a lot weaker. Now, in my case, the 10% line is the 50-week closing high less 10%, and that's in the ACP platform. Now, I thought it was kind of interesting. This is a chart I've used before. You could see some really bad things happen, not all the time, but fairly often once the market drops 10%. In fact, the whole basis of the TFM 10% system is that if a market is going to drop 50%, it's going to have to drop 10% first. So once it drops about 10%, with a few caveats, you might want to think about getting out. Now, obviously, the Great Depression is in here where the market lost 80% or so. of its value. But remember, the NASDAQ, as I just showed, lost about 70-something% of its value in 2000. 2009, you had about a 50% haircut. And then if you go to 2020, we were down around 30-something%. And obviously, after 10%, the market continued to slide. Now, it came back. Thank goodness. You know, I'm not a bear. I don't want to be a bear. Or a perma bear, I should say. But when things start getting ugly, the old hedge fund adage comes to mind. He who fights and runs away lives to fight another day. Now, one thing you have to realize is that bad things can happen in any market. In fact, all asset classes will lose half of their value at some point in your lifetime. I was looking at gold and some other commodities. The S&P 500's lost half its value at least twice in my lifetime. And I'm old, but I'm not that old, right? Keep in mind that markets don't adhere to statistics. In other words, they're not normally distributed. And the point I'm trying to make there is that markets go down a lot more than they should. They have much, much bigger haircuts, fat tails, so to speak, than they should. They shouldn't lose 50% as often as they do, but they do. Number 5, pay attention to signs and signals. Right now on my website, if you go to free stuff, you can get a lot more than what's just on the home page. You'll have to register there, or you can register with that aforementioned link, davelandry.com/StockCharts. Anyway, I have an article talking about the TFM 10% system, and you'll also have access to our free market timing course. So go in and learn about those signs and signals, and then of course catch up on YouTube on all my other Trading Simplified shows, and of course the weekend charts. And we recently got a TFM 10% system, sell system. Now, this was on a rolling basis and not a calendar basis. So technically, a calendar weekly would trigger on a Friday. But I see this signal as with designer's intent in mind. In other words, I felt like that once the market dropped more than 10%, it was officially a signal with a few other caveats that complete the system. But anyway, if you go to free stuff, davelandry.com/free stuff, you'll have access to this article and the market timing course. Number 6, avoid conservative investments. A relative of mine contacted me right before the pandemic, and she was in a bit of a panic. Of course, as usual, she waited until she was down 30 or 40 or 50% before telling me what she did. And they put her in a big cap conservative fundamental fund because she told them she wants to stay conservative with her money. And this is what happened during the pandemic slide. Notice on the bottom I have HV. Notice it was at really low levels and it shot up about 10 times from those levels. Now, just because something isn't that volatile doesn't mean that it can't increase in volatility. And you can see this conservative, and I'm making little air quotes, investment dropped nearly 50%. And notice, again, the volatility increased about 10%. And another one of the conservative, so to speak, investments they put her in was real estate. And look what real estate did. It dropped nearly 50% too. And then also the volatility increased by a factor of 10. Number 7, less is more. If you're on my trading service, which I put out every night, I'm probably boring you to tears lately because there's really not a whole lot of setups. They have one that I might show tonight that I'm thinking about. We did have one on my call list today that really took off, but unfortunately I didn't recommend it as an official setup, so I'm not sure how much credit I'll get for that. Maybe some client will be nice enough to pat me on the back for that. But anyway, long story endless, I haven't really recommended doing a whole lot in quite a while. In fact, it's interesting just to show you how human nature is. I've actually lost a few clients lately. I think they've gotten bored. I think they're craving action. And I have to tell you, I really wish somebody would tell me many years ago, hey, Dave, sit on your hands a little bit. Let this crazy market shake out. So I would encourage you to trade less and less and less unless you find something that just looks fantastic. And I thought this stock looked fantastic. This is a former mystery chart. And it was a bow tie. It triggered here. We had a stop down here, IPT up here, initial profit target, that is. It did hit the initial profit target, and it stopped out since. Full disclosure, I do still have some shares in this particular stock. But the reason I'm showing you this is the only long that I can remember for this year. In fact, this is the only one that is an official recommendation. I did trade a couple other longs this year, such as BRCC, Black Rifle Coffee, and SkyX. SkyX actually failed miserably, but the Black Rifle did okay. Anyway, my point is that you want to be selective, and less is more. I did an article called Cash is Not Trash, although it might be trash soon. I hate to confuse the issue with facts, but 80% of the all currency in circulation, the dollar that is, was printed in the last 2 years. That's a little scary, but I digress. Number 8, don't buy relative strength, buy absolute strength, okay? In my Facebook group, I've got a client that's been posting some relative strength charts showing which sectors are the strongest relative to the other sectors or relative to the S&P. That type of analysis is fantastic. I would encourage you to do that type of analysis. I'm sure you can do it on StockCharts.com, so check that out. However, you don't want to buy something that's just strong on a relative basis. You want to buy something that's strong on an absolute basis. Energies right now at or near all-time highs. Metals and mining at or near all-time highs. Defense stocks at or near all-time highs. Okay? Those are areas you should be focusing on the long side, and not a whole lot of other areas. Metals and mining might be another one that fits that mold. Number 9, if you are a little bit more advanced, I would consider shorting. But please be warned, prepare to have your arse handed to you. Shorts are a pain in the butt. I've been shorting futures all morning, and I've been getting knocked out all morning and dropping F-bombs all morning. So do be careful if you decide to short. We had a few shorts this year that set up. One, I think, hit the profit target, initial profit target, and that was it. And another one could have, a little discretion might have gotten you a little money out of it, but certainly nothing to brag about. The reason shorting is so hard is you have these unbelievable retrace rallies. They knock you out, usually right before the market turns right back down. It can be quite frustrating. So tread lightly if you've never shorted before. And oh, by the way, this is another one of the things I wanted to put in this list. Have your pattern or setup match the overall market. Right now, the market's in the early phases of rolling over from all-time highs, so find stocks that are also in the early phases of rolling over from all-time highs, as opposed to stocks that are at low levels and have been going down for 2 years. Those stocks, I wouldn't rush out and buy those stocks, but those stocks are probably closer to a bottom than they are a top. So the big opportunity is going to be on those stocks that are at very high levels and are just beginning to roll over. And I preach this often in the weekend charts. Go in and watch as many as you can stand. Just don't operate heavy machinery afterwards. Number 10, avoid positioning in inverse shares. The reason that I use the word positioning is that means buying and holding them for days, weeks, or even months. I think it's okay to trade them on an intraday basis if you are a little bit more advanced. You got to be careful with the day trading though, because we're really only wired to make so many decisions, and it can be very stressful. And I probably do a little bit too much day trading. I used to do little or none, and now I probably do a little too much. But lately I have been going in and shorting futures and buying inverted shares to sort of do a couple things, kind of mitigate some of the damage in the long-term holdings. And keep in mind, I do have stops on those, so there's very little left in my portfolio because I saw each position to its fruition, right, honoring that stop. Now, earlier, by the way, when I said see each position to its fruition, easy for me to say, I was talking about don't bail on everything, but the other thing that I meant by that was make sure you do honor your stop, and if you get stopped out, you need to exit the position. Now, this is why you don't hold these inverted shares longer term. This is SPSX, which you think would be going straight up right now, and it has gone up a bit. But notice on a monthly basis, it was at 6,000 a few years back, probably when it first came public. And now it's at $21. Literally $21. How crazy is that. And the reason is, it's a little complex, but I think the main reason is if you are running these shares, you have to be short the market. So if the market drops, you have profits, and you have to parlay those profits back into the short side. And it has kind of a reverse martingale effect. And if you don't understand what all that means, just know that you can Google it if you want to, and you'll know more than me. But just know that they have this kind of decay, so to speak, where they all tend to go to zero. Now, they'll never get to zero, because when they get down to the low single digits, in order to stay on the exchange that requires stocks be, let's say, $5 or more, they'll reverse split these things. As I often say, they will reverse split you to death in these inverse shares. So try to only hold these things for a few days. Ideally, I just like to go in, get my piece, and then move on an intraday basis for the most part. Well, that's all my time this week. I'm going to flesh this out in more detail again on Thursday, and I'm sure in upcoming shows, so stay tuned for that. If you need some more information, dailylandry.com/StockCharts. If you need to reach me, dailylandry.com/contact. I want to thank everybody for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.